Welcome to the MUFG Global Markets Podcast. I'm John Cook. I'm joined today by George Goncalves, MUFG's Chief of U.S. Macro Strategy. It's Tuesday, March 1st, 2022. Welcome back to the podcast, George.
Great to be on, John.
Always good to have you. And as you know about as good as anybody, markets have reacted violently, not only to the conflict between Russia and the Ukraine, but also subsequent sanctions. That being said, I've certainly noticed this myself. Other people have pointed out various markets have reacted really differently, and certainly to different degrees. You put out a really interesting piece recently entitled U.S. Macro Strategy, Geopolitical Analysis that makes a number of interesting observations of how markets, as well as the Fed, have reacted to previous geopolitical events. I'm kind of curious, if we can use some of these as guides. So take us through the high points.
Absolutely. No, we're definitely living in unprecedented times. And as I set forth in that opening remarks of that piece, there's no two periods are ever alike, but there are some similarities. And quite frankly, we looked at the major conflicts since World War II, and really that's when we have most the data sets that allow us to do this sort of analysis. And we found a number of things that were interesting. Obviously, there's been periods where the Fed was either hiking or easing, depending on what was going on in the broader economy. There were times where the Fed, would take into consideration what's happening globally. Even most recently, outside of the analysis that we did, there's been times in the last hiking cycle of 2015 through 2018 where the Fed also, leading up through it, as well as in the hiking process, would mention international concerns as a reason to be slightly more dovish or not be as aggressive with hiking. So the Fed obviously does not live in a vacuum, and will be taking into consideration the recent events and how that might impact the U.S. economy or through the back door, through the global economy getting impacted, and the dollar, and then eventually back to the U.S. markets. But the markets don't sit around waiting. Markets have had a pretty violent move, as you described in the beginning, and justifiably so. We just don't know all the unintended consequences that both the sanctions as well as where this conflict is heading, and hopefully there'll be some sort of peaceful resolution before things get worse. But markets are being very defensive now and worried about how many hikes are going to be able to be delivered. The access to dollar funding. I think all of these are big driver market forces that are driving price action. But in the study that we did, to kind of just quickly summarize it, there are, again, no two periods are alike. There are kind of three or four things that are worth noting. It's rare that the Fed is at the zero bound when we have a big geopolitical event. Outside of the Crimea 2014 period, there's really the Fed typically has rates slightly higher than zero, nor was the Fed about to embark on the start of a major hiking campaign. They either are in between adjusting policy when an unforeseen event happens. But the closest ones are probably the Yom Kippur War of the 1970s, maybe intermixing that with the Kosovo War of the 1999-2000, and maybe even like the 1968 Tet Offensive in Vietnam. And each one of those had their own catalysts and led to the Fed reacting differently. Really, the only time where the Fed raised rates and didn't stop was during the 1960s, when we had this similar kind of feel to what we're seeing now. Inflation was starting to get more sticky, and the Fed started to get concerned about that. So they did raise rates and continued to raise rates. But ultimately, though, what was interesting when I found by doing this analysis, after they got rates to even higher levels than what was happening during the initial conflict, they eventually had to cut rates because the economy just started to slow down. So I think it's at a minimum, if the Fed goes through and hikes a number of times, we'll discuss how many hikes we still think the Fed's going to do in a moment. But if they do hike, there is a risk that if things don't work out as well in 2023 or 2024, the Fed could be cutting rates again. So it goes back to the initial view that I've had since the beginning of the year that business cycles are going to be shorter, post-pandemic and post the sort of world that we're living in, a much more uncertain world. The 10-year we found, always and just intermediate and belly rates always rally hard and fast, but they can easily give up those gains once there is some sort of compromise or peace had, or at least the conflict is no longer at the peak concern. The big one for me is the stock market, which fits back into the whole financial conditions concerns that I've been having all year long, where the Kosovo War of 1999 happened at the doorsteps of the peak in the U.S. equity markets, where CAPM ratios were well north of 30, something very similar to now. So there's no two periods are alike. It feels like there's a combination of these various other periods where limited Fed's flexibility. So I do think that this, at a minimum, because the curves have flattened so much, perhaps the Fed will not be able to deliver as much.
Got it. Yeah, well, as Mark Twain famously said, history doesn't repeat itself, but it often rhymes. It seems appropriate at a time like this, and your piece definitely highlights a couple of different potential ways that could go. So continuing on this theme, it seems to me that the bond markets are struggling between will the Fed focus more on the growth impact from a prolonged conflict, or alternatively, will the Fed focus on the risk that inflation could go even higher from high energy prices, the crisis exacerbating existing supply side constraints, et cetera, et cetera. So I guess my question for you is, how should our listeners be thinking about this? What is the market telling us, and what do you think?
Markets, I think, have quickly changed their views now in the last 24, 48 hours, where a number of Fed hikes have been priced out. And now we're, I think, a little bit under 5 hikes for the year at latest pricing. And so I think the markets are now moving more towards concerns around the growth impact more so than the inflation impact, because we already have high inflation. And if the growth impact were to really start to set in, our listeners, as well as I've been a little bit more concerned about the second half and the deceleration that the U.S. economy is potentially going to go through. This would just only make it worse if we have these global disruptions continuing. So I do think the bond market is starting to entertain that view and is taking out these hikes around the concerns for growth. For me, we've been much more dovish relative to the consensus. We tried to avoid getting caught up in the frenzy of how many Fed hikes can the Fed deliver. I mean, in a perfect environment, the Fed can deliver all the hikes that were at every single meeting between now and year end. But as we know, that there's going to be exogenous shocks. This is one that was unforeseen, but there was some evidence of concerns around geopolitics at the beginning of the year, let alone this concern about the growth outlook. And for me, it was kind of triangulating how much tightening can the Fed really do before there's a negative feedback loop into financial conditions. At the end of the day, if anything disrupts financial conditions, be it the Fed's own policy or some sort of conflict that impacts sentiment, either way, it's going to, for me, is the channel of FCI, is it getting easier or tighter? And if that does change, that's going to force the Fed to also change its calculus as well. And so we never really changed our view around. We went from 2 hikes up to 3 hikes, and we haven't really added to that. The nuance of the 3 hikes were that we do think that the Fed should do QT. I'm not sure yet if what we've seen has been disruptive enough for them not to do QT, but it's something that's worth thinking about. If they do not do QT, then maybe they could do more rate hikes. But nonetheless, I don't think that they're going to be able to get much more than 3 or 4 hikes in this year. And if things were to get materially worse and financial conditions tighten more and stocks were to see a bigger, more sustained downturn into the summer, then the Fed may only hike twice. So that's the world that we're living in right now in a very real-time fashion. The Fed's going to be data dependent. They're going to be event dependent. They're going to take all this input and not necessarily just focus on the growth and inflation outlook because there's things that can derail the recovery, and I think we're entertaining that right now. And I think that's where we are now. Things can change, obviously, with new information. Hopefully, things get better, and we can easily see 4 hikes coming in. But now the market's already moved towards that. There's really not much risk reward being short the market until we get clarity on both Fed action, which we're going to find out more in the coming days, as well as the upcoming meeting in March.
Yeah, I believe we have Chair Powell on the schedule for tomorrow, which is likely the day that our listeners will be listening to the podcast. So we'll certainly learn some more then. And really like how you keep on coming back to the point you made in your 2022 outlook about how this financial conditions feedback loop could end up being a binding constraint for the Fed that plays out later in the year. It's obviously to some extent playing out a little bit earlier than we thought, but yeah, still something for sure to keep our eye on as the year develops. And again, for more, I would really encourage our listeners to check out George's recent piece, U.S. Macro Strategy Geopolitical Analysis. And if you aren't receiving George's strategy reports, again, reach out to George directly and he'll get you on the list. Thanks again, George. Great stuff as always.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.